Do you feel like there are fewer and fewer companies to invest in, even though there are more apps, more startups, and more next big ideas than ever before? You're not wrong. In the mid 1990s, the US had over 8,000 publicly traded companies. Today, that's around 4,500. It's a 50% drop. The market feels bigger, but it's dominated by fewer names. Think of it like a playlist that keeps deleting songs, but cranking up the same 7 hits. It's not just fewer companies, it's more concentration. The top 100 US firms now make up 70% of total market value. This is up from 45% in the 1990s. So when you buy an index fund, you're really buying an S&P 7 with a few extras for garnish. That means the public market, what you see in your brokerage account, is getting narrower and more top heavy. Meanwhile, private markets are exploding. Globally, there are about 215,000 companies backed by private equity or venture capital, compared to fewer than 9,000 public ones. Private markets have grown from $2 trillion in 2010 to nearly $12 trillion today. And there are roughly 95,000 private companies with over 100 million in revenue, compared to just 10,000 public companies of that size. So while your investment account can buy Apple or Coca-Cola, it can't touch Starlink, Stripe, or SpaceX, the companies driving much of the next generation of innovation. It's like the real party's happening behind a velvet rope. So why are fewer companies going public? First, it's expensive. Post-Enron regulations like Sarbanes-Oxley makes compliance a multi-million-dollar annual cost. Second, private money is everywhere. Venture and private equity funds can raise billions, no IPO required. Third, public life is exhausting. Miss quarterly earnings by a penny and you're a headline. It's part of why the Trump administration floated reducing quarterly earnings requirements to make public markets less punishing and maybe bring some companies back. The result, companies now stay private twice as long as they did 20 years ago, meaning the earlier growth often happens before the public ever gets access. Here are the takeaways. Number one, the growth story is moving behind doors. By the time private companies go public, much of the upside is already captured. Number two, public portfolios are more concentrated. With fewer stocks, index performance swings on just a handful of names. But number three, access is widening slowly. Big firms like Schwab are launching private market access for accredited investors, and more products are coming. But they're still limited, pricier compared to public markets, and not available on most platforms. So yes, new private access products sound exciting, but they're not replacing the public markets anytime soon. The public market is shrinking, the private market is booming, and everyone's scrambling to bridge the gap. Public markets still win on liquidity, transparency, and accessibility, the essentials for most investors. But knowing where the rest of the growth is hiding helps you see the full picture. Because in today's markets, not every great investment rings the opening bell. That's it for this week. This is Jeannie, the 401k lady.